Welcome to a very special edition of Coffee with Lynette. Today I have a really wonderful returning guest, my good friend Wolf Richter. His site is called Wolf Street, and on there you'll find in-depth writings on economics, business, financial issues, Wall Street shenanigans, lots of those, right? Complex entanglements and other debacles and opportunities that catch his eye. I can tell you his work is brilliant, insightful, and very, very understandable. And you know that I utilize his work all the time in my own work. I'm so happy to have him back. Today, we're going to talk about inflation, derivatives, CBDCs, and so many more things. So, Wolf, thank you for coming back today. I'm so happy to have you back, Wolf. Thank you for being here today.
Thanks for having me back.
Always, always. And we always have great conversations. And I want to jump into something that I've been talking about and exploring, and I believe you have too. And we're watching what's going on in the markets, and let's particularly talk about the bond markets and even taking it one step further, the government bond markets. And I think Great Britain is like the canary in the coal mine, right? And warning us about what's about to happen. So they're just like a step or two ahead of us. What do you think about the turmoil over there?
Well, they had leveraged pension funds that used a system of leverage that didn't go with spiking interest rates in the government bond market there. And so they tested this leverage, but nobody tested it for that kind of spike in interest rates. And so the system blew up, and so the pension funds had to deleverage and caused a huge amount of turmoil over there, which caused the Bank of England to step in and buy some of those bonds. And there's contagion, there's all kinds of stuff going on. And leverage does that. So when you have a leveraged position where something goes against you, you have to unwind the position and you become a forced seller and of a very large amount of securities. And that's the kind of thing when you have an over leveraged economy, you're going to run into that. You're going to have companies do that. You're going to have investment banks do that. You're going to have pension funds do that. And it's going to be one thing after another. I mean, this was a sort of a mini crisis that could have, spiraled further out of control, but it's now kind of wound down at a fairly substantial cost to the investors that were lined up on the wrong side. So I think we'll see plenty of this kind of stuff going on.
Well, I agree with that, but let's take that a step further, because I think that this is something, so correct me if I'm wrong, but I think this is something we agree on, that this whole scheme is Ponzi. It's all make-believe, and therefore it requires confidence. And so the crisis in confidence of the Bank of England, which is also something that we face here at the Fed. I mean, do you really think that everything is hunky-dory because they raised interest rates, which are tightening, and then they were forced to go in and buy bonds, and then they sold a little bit of the bonds that they did in the QE? So it's like gas pedal, brake, gas pedal. I mean, do you think that the markets and the public still has confidence in the Bank of England? Do you think they can pull this off? Do you think they can calm everything down and everything will be okay?
Well, we know things are not going to be okay because nobody expected to have 4%, 5% government bond yields this time around, and now we have them, and the UK has them, we have them, and Yeah, so a lot of, I mean, you look at your ordinary long-term bond funds, that conservative investors have invested in, they're down 30, 40%, and,
Yeah.
these are not, generally people that take big risks. And so now you have hedge funds out there that have hugely complex positions with leveraged positions with government securities, and you have these pension funds that did that. So I think central banks don't really want to control all of this. I don't think there's a good amount of well, let's just let some of these things blow up out there. I mean, it's gone overboard, and I think as long as it doesn't spiral out into a kind of a major crisis, I think they're just going to look at this and say, well, okay, so these pension funds lost a bunch of money. It's for somebody else to figure out how to satisfy the demands of the beneficiaries, because it's their money, it's got blown out. So I think central banks are going to let this run as long as there's no big major crisis.
Do you think they will let it run until there is a big major crisis that they're maybe driving us into?
Yeah, so this Bank of England got this one stepped out, this brush fire. The Fed has a different facility, has the repo facilities that it put in place a year ago. And so it can continue to do QT and raise rates if it wants to, but if it has a sudden flare up in some place, it can for a week or two act through the repo market, which is a multi-trillion-dollar a day market. So it's very huge. And if the Fed can calm that down, I think it can keep a brush fire from turning into a major national crisis and just keep on going. I think that's the plan here. And I mean, who knows what's going to happen? We've got a housing market that's really turning into a mess, and we've got inflation. So inflation is keeping all the central banks away from buying stuff. If you have 8%, or in the UK they have 10% inflation, if you restart QE and cut rates down, you're going to have hyperinflation. Right. I mean, it's all over.
Well, I think that's where we're headed anyway, is to hyperinflation. But when we look at what's happening to the bonds, the government bonds in the U.S., like the U.S. Treasury, and you look at the Treasury, notes, the 10-year notes, and you look at that the Treasury may have to step in as buyer of last resort, because there's rapidly evaporating liquidity in these markets.
Yeah. Well, that's an interesting deal, actually. They've considered this before, and I've done it before. What the Treasury would do would essentially buy old, long-dated bonds that are hard to trade. I mean, if you ever had a 30-year bond that's 10 years into it and you're trying to sell it, I mean, you can sell it, but you're going to get ripped off, because that's just how it is. And as a retail buyer, I don't do that anymore. I buy at auction, hold to maturity, and because you get ripped off with these older bonds if you try to sell them. And so they would buy those older bonds, and they would issue newer bonds that trade more easily. So it would be that kind of swap, and that would create liquidity through that by essentially exchanging these bonds. It's a complicated thing, and I'm not sure they will ever do it. You have all kinds of issues with that, but they discussed it, and you have a big institution that sits on $2 billion worth of older bonds that it has to sell, like those pension funds. That's where you get a liquidity crisis, because there may not be buyers out there that can buy at a price, or that want to buy at a price that the pension fund or the hedge fund can survive. They're going to buy at a much lower price, and it causes this issue. And so this is what's called liquidity in the bond market, where it really means that you can't sell for the price that you want to get, or that you have to get. And there's a price out there, but it's a lot lower. And that's when the bond market talks about lack of liquidity, because buyers are kind of, okay, I'm buying, but not at that price. I'm going to be lower.
Right, a lot lower. So where would the Treasury get the money to buy the bonds that are in the secondary market, and then swap them into new bonds.
Yeah, so it would have to issue. I mean, it has a lot of money in its account always, you know. I mean, it's a huge checking account it has. So if it's a smaller issue that it buys, it can just flow it through. It's issuing a lot of bonds all the time, and it's increasing the bond issuance now in the fourth
Right.
quarter. So that is essentially a trade. Now, it would issue new bonds, and it would use those funds to buy these older bonds. And so it wouldn't really impact the overall debt of the United States. It doesn't really do anything in terms of the overall debt. It just changes the types of bonds that are out there.
And the maturity of the bonds, are they going? They're going shorter.
Yeah, so I don't know how they will do that. You know, I mean, they could go shorter term, but you know, there are also complications with that if they do that. You know, so. I mean, they could go longer term, or they could, if there's a 30-year treasury that has 10 years left, they could issue 10-year notes, for example, instead of 30-year bonds. But I don't know if they'll ever do this. You know, there's been some discussion about this, but it's just complicated. And the bond market liquidity isn't that bad. They don't really have to do it. It's just sellers are going to lose a little bit of money when they sell. That's all that means.
So would they be doing this primarily for the banks that are holding the treasuries on their books, do you think? Just to enable them, like they did back in 2008 when they paid AIG 100% on their derivative trades, so that those losses were not passed on to all of the other banks on the other side of those derivative trades, Citi, American,
Yeah,
et cetera,
I
Bank
don't.
of America.
I mean, I'm not thinking of the banks at this moment. I'm thinking of big leverage funds like a hedge fund or these pension funds that might be forced to sell, you know. And treasuries banks hold treasuries as a form of capital. So, and they have other ways to deal with the Fed, and they have the repo markets available to them, you know, and they have other
yeah, and the
things.
hedge funds are big repo buyers as well.
Yeah. And you know, the hedge funds that borrow in the repo markets, and the banks usually lend to the repo market. And so that when the hedge funds borrow in the repo market and the repo market gets leery of them, the funding disappears. And then they have these long-term leverage positions, and they can't get funding for them. And you know, we had this issue in late 2019 with the mortgage REITs that blew up. And I couldn't get their funding in the repo market anymore. And then the Fed stepped in to bail out the repo market. So, I mean, this is the kind of stuff I expect we're going to get, you know, this.
Well, you may, and I want to come back to that in a second, but I want to veer here just for a minute because you brought it up before, and you recently did a piece on the housing bubble popped and the Fed can let it rip. So can you talk to our viewers about why the Fed can now when the housing market is 30% of the US GDP and more in some places. So it's a really important component of the global economy. Why can it let it rip now?
Well, it's because of the banks. Last time we had the housing bust, the mortgage crisis was really taking down the banks, you know, and this time around, the risks have been spread far and wide. So number one, a very large portion of the mortgages have been securitized into mortgage-backed securities and have been guaranteed by the government. So it's the taxpayer that's on the hook. And then there's other mortgages that have been securitized into private label mortgage-backed securities. So the government is not on the hook, but they are spread around among global investors. So insurance companies, pension funds, bond funds, you know, if you have a 401k with a bond fund, and you probably got some of those. And so the risks are really spread away from the banks. The banks are not that exposed anymore to mortgages. The exposure is pretty small by the banks to residential mortgages. Now, there are some banks that, regional banks, or smaller banks that have a large exposure, relatively large exposure to commercial mortgages. And so that could be a bigger problem, but the numbers are much smaller. You know, that these are relatively small banks that are relatively concentrated in their local commercial mortgages, and such as office buildings and those kinds of things. And they're eventually going to go bad, but that's yeah, that's not a systemic banking issue. That's just going to have one or two banks that are going to topple because minor, smaller banks are going to topple because of that. So if it's residential mortgages, the banks are essentially off the hook now. It's the investors and the government or the taxpayer that's on the hook. And so the Fed is there to protect the stability of the financial system. And that's why it stepped in last time. So this time it could still step in, but now we've got 8% inflation, so
it's a lot harder. Their hands are kind of
their
tied.
hands are tied, yeah. And they said we're going to have to take care of inflation, and the banks are not at risk, so we don't worry about the banks, and the housing market will find its own. It's a market, markets are very good at finding their own level where they're supposed to be, where they want to be. It's a little rough getting there, but they'll find it, and
they're left alone.
Yeah, that's what markets
right?
will do.
But just kind of staying there for a minute, because I know a lot of the mortgages and all of those products have been offloaded to shadow banks that have created these products and sold them to the public. So yes, of course, they're going to eat it in the shorts. But don't these private or these shadow banks get a lot of their funding from the commercial banks? So there might be like a little separation, but it's not a complete separation.
Yeah, so in these shadow banks like Rocket companies, that the largest mortgage lender in the United States. So what's different from them and to regular banks is that they don't get the funding from deposits.
Right.
So they get the funding from borrowing or from selling the mortgages and or from bonds and from whatever. So they get the short-term funding from banks. And so they get $1 billion line of credit from Wells Fargo or from a consortium of banks. And then they use that to fund the mortgages. And then when they have enough mortgages together, they bundle them and they essentially sell them to somebody like Fannie Mae or Freddie Mac, and then they get the money back and they pay off the bank. Yeah, so you have a certain amount of time that a shadow bank sits on these mortgages, and these mortgages are funded by a warehouse line of credit from another major bank, and then the bank is at risk for that line of credit secured. So the shadow bank is at risk for those mortgages it has on the books during that time. And there's other issues that we have seen this year because mortgage rates have just spiked, which means the value of the mortgage goes down. So when Rocket sits on $1 billion in mortgages that it's trying to bundle and wait, and the mortgage rates during that time spiked by 2 percentage points, there is a big loss involved when it sells them. And that's what happened. And all the stocks got, crushed. These shadow banks are in my pantheon of imploded stocks. They have gotten completely crushed, and they've laid off thousands of people, and that whole business is cratering because it was relying on refinance mortgages. That business has gone away, but the Fed doesn't regulate them. The Fed doesn't really care. It's not their business. It's a company, publicly traded company. When they go out, stockholders lose everything, and the creditors are going to pick through the debris and see what they can get, so that is part of letting it rip. The mortgage business has moved away from what the Fed regulates. It doesn't regulate the shadow bank. So
that almost makes it, I can't say scarier because I don't think the Fed does a very good job. But I think in so many ways, a lot of the risk could very well be hidden, kind of like an iceberg. So we see this little piece, but there's so much more underneath that could turn into a black swan event that nobody can see coming because it's opaque.
Yeah, and you're right. The things we're worrying about today, they're not going to blow up.
Right, exactly.
Something else is going to blow up. Something we're not worrying about. And nobody in the UK was worrying about these pension funds.
Right.
Nobody ever even knew what these LDI funds were. For the first time ever, people realized, wow, this is interesting. Leveraged pension funds like that. What are they doing? And
Well, this
It's
was
not.
the result of the reach for yield, right?
Yeah.
You know, financial repression where they push those interest rates and savers take it in the shorts because although they've been doing that since 45, more hidden. Now it's not quite so hidden. And
Mm.
there was just an article that I was reading, and the UK may have to institute financial repression to, you know, to protect the markets, and it's a joke, isn't it?
Mm. Well, now that, with 10% inflation, they can't really do financial repression because you would get, like you said, hyperinflation, and so the thing that they can't control, what a central bank cannot control, is inflation. They can only try to take the fuel away from inflation, but they can't dial it down. And
Right.
they can repress interest rates very effectively through short-term rates and through the QE operations. But when inflation takes off, the only thing they can do is remove the fuel. And if they don't do that, if they keep throwing gasoline on inflation, it's going to go way out of hand, and it's going to destroy an economy. And they all know that. I mean, that's not a secret. They know that. And so that's why the central banks I think they're going to just, whatever stuff blows up, they might try to keep it from forming a national crisis or international crisis, and essentially then step away and let it go.
That's really what the problem is, because I mean, what I'm seeing is, on the one hand, by raising rates, you have your foot on the brakes, so you're trying to slow it down. But on the other hand, like the Bank of England had to go in and buy bonds to stabilize that market. And the treasuries have been taken over by traders. It's really more of a trader kind of, everything is, oil, energy, food. It's all really being controlled by Wall Street traders. And I'm going to say that globally just so people understand that that it's about making a dime. It's not about, suppressing or controlling or having like a very regulated, steady kind of economy. That's what really scares me, you know.
Mm.
And that's also, I think, what's contributing a lot to the inflation. Do you have an opinion on that? I mean, it's something I actually saw on today on Bloomberg, where for the first time they actually indicated that it was the traders that were creating all the volatility in the treasury markets, and I'm going to extend that to other markets because
Yeah.
everything's based on those options and futures and trading,
Yeah, I mean, the
derivatives.
financialization of everything. I mean, that's kind of what I call it. Yeah, that is a problem. You have
Huge.
huge amounts of all kinds of trading instruments being created, being traded. Um, there are secondary effects, and a lot of this is sort of unpredictable what happens.
Exactly.
I mean, so in a sense, and I don't hope for anything bad, but in a sense, I hope that the central bank tightening that is now taking place in most parts of the world, in many parts of the world, that will somehow cause enough losses in enough of these activities to where these activities stop, where it's no longer profitable to do X, Y, and Z. It just blew up and people lost their money. And then it's no longer profitable to A, B, and C. And that blew up and people lost their money and they stopped doing it. And so gradually, maybe we're kind of narrowing down the financial activities and to where, I mean, the markets are really important. There's a lot of things that are set in the markets, and
Right.
they're really crucial. But when everything is just, the whole economy is based on we're just trading with each other, these synthetic products, then it's like, okay, this economy's got a problem. We got to somehow get back to a real economy, and I hope we'll see some of that, and I hope the central banks will allow this process to happen over the next few years, many years.
So do you think, and I agree with everything that you just said, and we do need to get back to a real economy. I just don't see a clean path to get us there. I mean, there's lots of wolves all over the place. And we're seeing a lot of investment banking firms, that have been reducing their staff because it's just not.
Yeah.
But how do you see us? Or do you see some kind of path to getting us back to a real economy without things just exploding into,
Mm.
a hyperinflationary depression, which is what I think we've got in the very near future? I mean, how can they do that when they've just abused the system so badly?
I see some steps of that already on that path, and it's not a smooth path. It's just rough and ugly, but it's functional. And I'm looking at the SPACs and the IPOs in the stock market. That was a
Yeah.
huge, gigantic bubble. It just, it was just enormous. 2020, 2021, even in prior years, and it blew up, and it started blowing up in February 2021. And stock by stock. And I have to say, it's orderly. These stocks lost 95% of the value. Some of them went bankrupt, and trillions of dollars went up in smoke, but it's relatively orderly. We haven't had any kind of major explosion based on that. And if we take time, markets are pretty good. If you give them some time, they're pretty good at working these things out. And I mean, people are losing a lot of money, but that's how it goes. So long as you don't have chaos, and so far we've had pretty good progress in working through some of those things without chaos, and so I keep my fingers crossed.
I think that's pretty much where we're at. We've all got to be keeping our fingers crossed. And then on the other hand, you kind of want all this garbage just to be burned off, because we have that huge LIBOR SOFR shift in the U.S. coming up, but the shift to a new benchmark on a global basis, that's coming up in less than a year, right? And we have the CBDC race that is kind of going on, but we also see cryptocurrencies in a crypto winter. Do you have any thoughts on any of that? That's a lot to unpack, but I'll bet you.
Yeah, I mean, cryptocurrency is another thing that has unwound in a fairly orderly manner. I mean, today we've got another big issue, but it's fairly orderly, I have to say. I mean, sure, people lose money, and there are rug pulls and things just suddenly vanish, and there's all kinds of fraud coming out and different things, and we've had first bankruptcies, but that's how a system cleanses itself, and it's been fairly orderly. So I have to say, so far so good. It's a cleanup process that's pretty messy, but amazingly orderly so far. And we haven't had any kind of major pension fund blow up like they had in the UK, and
Yet.
And I don't know how leveraged the funds are here. They're leveraged. I know that. Some of them issued bonds, and then some of them other things. And the LDI strategies are being used, but not to that extent, maybe. And then there are the hedge funds that might blow up. Occasionally, we have a smaller hedge fund that blows up, and it doesn't really do much. So far so good. I'm just amazed how day after day there's something else, and it's blows up and goes away, and then something else blows up and goes away, and it's still a fairly well-functioning market. So they're doing what they're supposed to do.
Well, you kind of say, and this is really a good thing, because it sounds like you have hope. Do you think they're going to be able to work through all of these overvaluations and all of we really have no idea what's really happening in the derivative market. That's the market that's so opaque, really, that we can't really see it. So good that it's kind of looking orderly out here, but what is your feeling in where we're headed, particularly?
Well,
go ahead.
With derivatives, I mean, that's always out there hanging over us.
It is
forever.
It is.
They're there, and you just hope that there's nothing that's going to blow up, and when they do blow up, it'll you say, oh yeah, that's derivatives. We kind of expected that, but it'll come out of a direction nobody ever thought of, So I think that can happen. I think we can have a problem with those derivatives. We can have a problem of all kinds, I just don't think the housing market will pose a problem. I don't think the stock market, the cryptos will pose a problem. I think those will be that the process there is fairly orderly. The
So
economy is still doing.
well, what do you see that could pose a problem?
Well, right now the big problem is inflation. Really, that's what I see. This inflation is nasty and it's messy and it's spread across the economy and it's spread deeply into services. I've been saying this for a month, been screaming about it for a month, for over a year. The Fed's finally started to echo that, and and it's really hard to get rid of once it's in services. And it'll go down a little bit, and then it'll come right back up. We've had this kind of whack-a-mole effect of inflation, where used car prices spike like crazy, and new car prices spike, and now they're coming down, but now something else is spiking. So the gasoline, that's kind of off the peak, and now we've got services and rents and all kinds of things, and that's how it is. You get one item down, another item pops up, and I just don't see inflation will go away. I think it will be with us. I think it'll be higher than expected. It'll be higher for longer than expected. We'll have higher interest rates for longer than expected. This economy will have to adjust to much higher interest rates for much longer. And in many ways, that's a good thing. When the cost of capital needs to be real, for people to make for decision makers to make the right kind of decisions, and it needs to be above the rate of inflation, and I think we're moving that direction, and I don't think we're going back to the 0% interest policies and for a long time, if ever. I don't think we're going back to QE, and in the asset markets, everybody thinks, oh, the Fed's going to pivot. I've heard this now since May. The Fed's going to pivot anytime soon. Now, I don't think the Fed's going to pivot. I think this is going to be rough going forward. There's going to be higher interest rates for longer, and QE is not going to happen, and asset prices are going to go down, and it's going to be a terrible investment environment, and it's going to be your choice to find the least terrible thing you can invest in. And
well, okay, so let's say that inflation keeps going. Here's the problem. Here's one of the problems that I see. There is virtually no purchasing power left in the currency, and inflation takes away whatever purchasing power is left in the currency. So that's the setup for going into CBDCs, which central banks are going to sell as there will be no inflation. No, because it'll be deflation. They'll start attacking your principal with negative rates. But, how do you overcome the fact that doesn't there have to be some level of purchasing power in the currencies to inspire people even to work?
Yeah, there's purchasing power. My $100 in my pocket, I can still buy something that just don't buy as much as they did, a year ago or 2 years ago. That's the thing. In terms of the digital currencies for central banks, as you mentioned, the problem we have today is that transactions are slow and expensive. And so if you ever made a wire transfer to Europe, both parties get ripped off. And so there's some fintech companies that come out and it's a lot cheaper, but you're still buying currency, you're transferring currency, you're doing those things, and there's fees involved, and there's spreads involved, and there's different things. So the idea of a digital currency from the central bank is to create an instant payment system that's essentially free, and we have like Zelle. I use it a lot with US banks. I can send you money, and within seconds you get the notice that you have it in your bank account. But that's not a currency. That's just a free payment system that the banks have gotten together on. But if you have a different setup where payments are, trusted and they're instant, and that would benefit, I think, a lot of transactions. And right now there's a lot of friction in transferring money, in all kinds. And so I think that's the idea behind the central bank digital currencies. There's a lot of writing about how they're trying to, do this and do that. But in the United States, the paper dollars that we have in our pocket, that's not going away. And it might lose value, it might lose purchasing power, but it's going to stay there. And I'm not worried that the Fed is worried about destroying the banking system with its central currency. And that's why they're so slow, because the banks are making a huge amount of money off these transactions.
Mm-hmm.
And so if you have a central bank that issues a central bank digital currency that you can transact in, you bypass the banking system to do that.
Right.
And that's a problem, so the Fed cannot just go out and take a big slice of the bank's income away. That's why they're slow walking this. I mean, they're like just talking about it. Then they're really not wanting to do anything, because that's a real issue, and other central banks that the Fed, the 12 regional Federal Reserve banks are owned by their financial institutions in the districts,
Right.
So they're not going to do anything against the banks. In other countries, that's not necessarily the case. And so I'm not super worried about that. I really dislike the way the payment systems work in the United States. I mean, especially in the United States. When I lived in Europe back 20 years ago, already transactions were free and very fast, between bank accounts of different banks. And we still don't have that here. And we have a little bit participating banks, but there's no universal free transfer of money that's instant and trusted. And so, that's frustrating. I think it's bad for the economy to not have a good payment system, a modern payment system. And so if they come up with something useful, I think I'm fine with that. If they come up with some shenanigans, I'm going to scream about it.
Well, here's one of the things that I uncovered when I was doing some research on it. And I agree with the payment system. So this has nothing to do with that. But what it does have to do with is that they're changing the definition of the functions of money, which originally was, as a tool of measure, as a tool of barter, as a short-term store of value, so you were fairly paid for your labor, and a long-term store of value, so that whenever you use that money, you were always fairly paid for your labor. Well, I don't know when they changed this, because I couldn't find where that cutoff was, but they took off the long-term store of value. Okay, that makes sense, because inflation robs you of that anyway, and that's part of the plan. But in this new system, that being fairly paid, short-term store of value, being fairly paid for your labor, that has disappeared. Once they institute CBDCs, that goes away. So that when your pay gets deposited in your account, it is automatically subject to negative rates. I have a real problem. I have a real problem with that.
Yeah, I don't see that. I mean, sure, people write about this, but I
No,
don't.
that comes from the IMF. Their documentation, not my supposition.
Yeah, I mean, the IMF may be talking about this, but I just don't see that happening. I mean, the IMF has come up with all kinds of stuff over the years. I mean, I just don't see that happening. And there was a time when.
Well, I hope you're right.
When there was a time a couple of years ago when negative rates were what the IMF actually encouraged, in many places. Somehow there was the panacea for a lot of stuff. And it, they have destroyed, now we see that looking back, the damaging impact of those negative rates in Europe and in Japan and elsewhere, So I mean, anything could happen, but I don't see that. That's not on top of my worry list.
Not yet. It'll get there. I'll tell you what, it's on my worry list. But then maybe the inflation is a good thing, because after all, the negative rates are going away.
Yeah, I mean, I think we finally have inflation. That's how I see it. We finally have it because, when they first started doing QE in the United States in 2008, and 2009 and 2011, I thought, 10, 11, I thought we're going to get massive amounts of inflation. We never did. And we got asset price inflation. We never
That's
got
what we
consumer
got.
price inflation.
Mm-hmm.
Japan had been doing it for 20 years. They never really had a lot of consumer price inflation. And then the ECB started looking at us and saying, oh, they're doing QE and they're just getting asset price inflation. So when they had the Euro debt crisis, they started doing it.
Mm-hmm.
And so we learned, the central banks learned the wrong lesson, saying interest rate repression to zero or below zero works just fine. QE works just fine. We don't get any negative effects on consumer prices. What we get is asset price inflation, and that generates a little bit of demand. And so, good, let's do that. And this whole concept has blown up now.
Yeah.
I'm really glad that it has, and I'm really glad we have this inflation finally, because it ends this misconception that somehow QE and negative interest rates or zero interest rates are good for the economy. They're not. There's a price to pay. Now we're paying it and everybody sees it. And so I'm really glad we have it finally, because I think that's the end.
I actually agree with you, but maybe for a different reason, because rapid inflation makes the public more aware of the abuses of the central bank. It just makes them pay attention, or at least to what they're putting in their grocery carts, and that's the problem for the central banks and the governments. It's that
and
confidence.
I totally agree with you. I mean, the inflation has that impact that the public finally starts paying attention to some things. Unfortunately, central banks have this Teflon coating on them. And they never get blamed for anything. They can do whatever they want, blow up whatever they want. It's always somebody else's fault. And inflation is the same thing. I mean, nobody ever blames a central bank for, having done too much QE or QE at all and repressed interest rates too low. And they never say, oh, it's our fault. We screwed up. And
no, they never say that. But,
yeah.
I'm hoping that between what your work and my work and a bunch of other people's work, the public starts to understand that is where a lot of these problems are coming from. Yeah. And they're trying to keep control. We're going to go full circle here. They're trying to keep control of the confidence of the public.
Mm-hmm.
And because if they lose that, that's really when the hyperinflation starts.
Yeah. That the whole system is based on confidence. And you look at countries where people have lost confidence in their own currency. So Argentina, Venezuela, Turkey, many of them. They no longer want to hold their own currency. They get rid of it. Yeah. And they lost confidence in the currency and they shed it. And that's when you get this massive bout of inflation. When your own people lose confidence in your currency. You look at Japan, the Japanese people, they treasure their yen. When they pay for cash or something, they take this 10,000 yen bill out of their wallet carefully with 2 fingers and present it with the right hand. It's just like a ritual. It's never crinkled. I have my money in my front pocket when I'm in Japan, and they just look at me aghast, And they take pride in the currency, and that's in part why they haven't had any serious bout of inflation despite QE. They haven't lost confidence in the currency, and that's starting to
incredible.
Incredible, yeah. But it's really ingrained, But it's you can see it now. It's starting to a little bit, and they've got inflation over there now, and it's pissing people off. And the central bank, they got in hot water by saying people need to get used to it and that kind of thing. And it's like, oh, that was tone deaf. They shouldn't have said that, And
well, what did Powell say? There will be pain. Yeah. Okay, well, I'm pretty sure that he's not going to feel the pain, but there's a lot of other people that will feel the pain, and they might not like it.
Yeah. Well, we should have thought about it in 2008 when we started this QE. And there's lots of people that warned about that. We're going to get lots of inflation, and we didn't get it right away. And so they were blown off.
Right.
And so I think in some sense, I'm it is interesting, that I can see if this is allowed to work its way through the system, there'll be a better system afterwards.
I agree with you.
That's how I look at it. Yeah.
Yeah, I'm not sure that they have the pain tolerance, meaning central banks and governments. I'm not sure that they have the pain tolerance to allow all of this garbage to work itself out. Time will tell, because I think they're all fighting for their credibility right now.
Yeah.
I think they've kind of blown it. But
Yeah, and you've got politicians in Washington, they have zero pain tolerance. They're out there buying votes, and so who knows what they're going to do, and so that's always the wild card. I mean, they could make things a lot worse.
absolutely, and they probably will, because nobody's working together. I mean, everybody's over here. It's just a kind of every person for themselves, but the public does need to come together, right? And that's what happens with the high inflation or with the abuse. When people get ticked off, then they do come together and create these new communities that, frankly, could be, more powerful than those that are currently in power. And while I'd love this to continue for hours and hours, I want to respect your time. So we've covered a lot of areas, but is there anything that you are seeing right this moment that people really need to be focusing on and paying attention to that we haven't talked about today?
Yeah, no, I think the critical thing we have talked about, so that's inflation and high interest rates going forward, and not hoping for a pivot. I don't think that's going to happen.
Not until this next black swan event.
And even then, it's not going to be a pivot unless inflation goes away. It's going to be some mini bailout of some sort. But this inflation has changed things. I mean, it's 40 years. Most people weren't even around, or weren't adults last time we had this thing. And it's a bad time. So, I mean, that's what's on my mind, is the system is changing now. 14 years of monetary policy have left us with this mess. And so now we've got to dig through it.
Yeah, and there really is not any choice. It's not just going to go away magically. We're going to have to deal with it. Well, thank you so much. This has been wonderful. And I can't wait to have you back again, because I could keep going, with this conversation for hours. You're fabulous and so brilliant. And all of the links to Wolf's work are below and also on the blog. And I'm sure that many of our viewers are already taking in all of your brilliance at your website on Wolf Street. But if you haven't, then you need to go over there and look at his work. I know I read it all the time. He's brilliant. I love it. And thank you so much for being here today, Wolf. I really appreciate it.
Thank you for having me.
And to all of you viewers, please be safe out there. Bye-bye.